For all the wailing about negative bond yields these days, governments are still able to sell these securities to supposedly intelligent, well-informed investors. There's a good reason. Bonds provide a fixed coupon guaranteed by these issuers. Now let's put aside the matter of losing on the bond price. At least some income, however derisory, will go to these holders every year. Now, as these bond yields slip ever lower each year, companies which can offer a high dividend have started to gain favor. Indeed, dividend yields in the UK have exceeded those of gilts for the past few years. So it's no surprise then that specialist income exchange-traded funds, which focus on the highest yielding stocks, have outperformed the broader indices in the US and the UK. Nevertheless, companies usually have no legal requirement to pay anything to their shareholders. So sustainability of the dividend counts for a lot. In the UK, most of that income comes from relatively few companies. Think about this. Just 10 companies should provide just over half of 2016 forecast dividends for the FTSE 100. These multinationals offer an average yield of over 5%. That's way above 10-year UK gilts. Unfortunately, their dividend coverage, the earnings as a ratio of dividends, looks pretty low at just over 1 times. Usually less than 2 times cover would concern a conservative investor. None of the highest yielding FTSE companies, over 6.5% yield, have a ratio of over 2. A company financial director, though, cares more about having enough cash flow, not just after-tax profits, to pay the shareholders. For some of the largest non-financial FTSE payers, their free cash flow after investments barely covers their dividend, if at all. That means they may need to borrow or sell assets to meet dividend payments. Now, big oil companies such as Royal Dutch Shell and BP, they already struggle to pay, but even less cyclical FTSE firms such as GSK and Vodafone barely cover their dividends with cash flow based on 2017 estimates. So don't yield to the temptation of buying high-yielding stocks without checking that their corporates can keep up the payments.